When it comes to stock analysis, there are two types of analysis you can carry out. Number one is what we call the quantitative analysis. This is where we look at the financial statements and we begin to analyze, looking at the margins, looking at the yield, looking at the ratios, looking at the percentage growth, looking at the income statements, looking at the balance sheets, looking at the cash flow statements. That is for quantitative analysis, aside from the aspect of technical analysis. But there's another important one which I believe even if you are not a number person, you are not a chartered accountant, you are not a financial analyst, you can still do those basic ones. And that's what I want to talk about in this video. It is called qualitative analysis. You can pick a company based on this alone, based on this analysis alone. And I can tell you that you can pick good stocks based on this qualitative analysis alone. For instance, the question is, you yourself, what kind of products do you use? What kind of products are you familiar with that you can't do without them? Or you know that people cannot do around them, whether in your household, in your office, or maybe in your place of worship. You know that people cannot do with this without these products. Let me cite an example. For instance, you are here on YouTube watching this. YouTube is a company and it is listed on the New York Stock Exchange, which means named as Google. So which means it is in high demand. Facebook is in high demand because people use it for social media. Now let's come to Nigeria. For instance, people will always eat palm oil. People will always need oil and gas. Am I right? People will always eat. Am I right? So which means consumer goods will always be in demand. So that's what we talk about when we talk about qualitative analysis. But I want to talk about three things you need to check out. Three factors you need to check out. And I'll be talking about 5 things you check out in the first one, 5 things in the second one, then 3 things you need to check out in the third one. So number 1 is growth potential. Number 2 is competitive advantage. What competitive advantage does this company have over others in the same industry? Does it have any competitive advantage? You will need to analyze that. Then you look at the leadership. Those are the aims of affair. Those directing the company. What are the things you need to know about them? I will also talk about it. I hope you understand. So let's go ahead. So when we talk about growth potential, we are talking about how fast or how slow is that industry. Is that industry a growing industry or a declining industry? The industry in which that company is. Because, for instance, can you imagine that somebody is now setting up a company that wants to start producing typewriter in this day and time? It is a dead industry already. I don't know whether you get what I'm saying. It is a dead industry. Nobody is using typewriter in this day and time. Or maybe a company that is producing films, not digital camera, but films. Can you imagine? It is a declining industry. So there were pointers to a declining industry, even when the likes of Kodak, when they were making cameras. But some of them did not pivot. So when you see things like this, that no, this industry is a declining industry, then what do? You know that it is not a go area, even if they recommend it to you, because you know that this industry is a dying industry. It's already declining. It does not have a future. I hope you understand. And if it is a growing industry, then you move on to the next one. How relevant is their products? The services they are rendering, is it relevant to this day and time? Is this something that people are in need of? Is it an essential? Is it want or is luxury? Is it relevant? That's number 2. Number 3, is it future relevant? So it is not enough that it is relevant today. The question is it future relevant? Will it be relevant in the next 5 years, in the next 10 years, in the next 15 years? This will help you to determine the kind of stocks you are going to keep for long term. If this is not answered, If you are not sure that the stock will be relevant, or what they are doing, the product they are rendering, the product they are selling, or the service they are rendering is still going to be relevant in the next 10-15 years, it tells you that you need to only hold it for short term. I hope you are getting basic analysis, qualitative analysis, not quantitative, because most times you see people talking about quantitative, but I can tell you that even if you do qualitative analysis, you are good to go to pick stocks. Picking stocks is not rocket science, especially if it is for long term. For short term, you may need technical analysis, you may need to look at the price, study the price action, but when we are talking about investing for long term, it is not so much a rocket science. Now let's move ahead. So future relevance. Number 4 is the competitiveness in that industry. Is it a competitive environment? As when I say competitive, it is highly competitive, which means growing in such an industry, for such a company, it will need something we call the economy of scale, which we are still going to be talking about in point 2. I don't want to jump ahead of myself. I'll be talking about the things that gives a company the competitive edge. So even though the industry may be competitive, it may be highly competitive, yet if the company has competitive advantage, and I'll be mentioning 5 points that could give a company competitive advantage, then you will understand. Then you will know that, oh, it is a good company, let me go for it. Not necessarily the 5, but at least, let's say 2 or 3, or even one solid, even if it is one solid point, competitive advantage that it has, then you are good to go. Then the last one, what are customers saying about these products? What are they saying about it? Is it a product or services that are being embraced by their customers, or it is already a product or service that people are already complaining about, that the populace, their customers are already complaining about? I will give you an example. DSTV, for instance, multi-choice, people were complaining about it, but they never paid attention. Give us pay as you go. They were doing monthly pay monthly, but at the end you can see what is happening to them, just because. So if you are listening, if you invested in multi-choice, for instance, and you notice such a thing, it only tells you one thing, that before you know it, this company is going to go down and it's going to affect the stock. So that is number 1, which is the growth potential. Number 2, the competitive advantage. When we talk about competitive advantage, which means what gives this company an advantage in the market? Does it even have any factor that gives it an advantage over others in the industry? Number 1 is the pricing power. Does this company have pricing power? I will cite an example. In Nigeria, for instance, the cement industry, they have pricing power. Dangote Cement has pricing power. MTN has pricing power. If not for regulation, these companies have pricing power. If not for regulation from the government that they need to regulate them, they have pricing power. Once they increase their prices, people will still buy them. What about Nigerian breweries, for instance? They have pricing power. I hope you understand what I'm saying. So, does it have pricing power? If it does not have pricing power, what about switching costs? When we say switching costs, what does it cost a customer to switch away from their product to another product? If it is very easy to switch away from their product to another product, it means they do not really have an advantage when it comes to switching costs. I don't know whether you understand what I'm saying. For instance, you've been using a particular product, and the day you get to the market, maybe your customer, your vendor does not have that particular product. Can you easily switch to another product? If you can easily switch, it does not cost you anything else to switch, then it shows that they do not have the switching cost advantage. Then number 3 is trade secrets. Trade secrets. For instance, Coca-Cola has trade secrets. That's why it continues to have that advantage. Trade secrets. So some companies like that, they have trade secrets. So does this particular company has a trade secret? Number 4 is what we call barriers to entry. How easy is it for new entrants to enter that industry, to come into that industry. I will cite an example. An airline industry is not something that somebody can wake up tomorrow and say, I want to go into the airline industry. It is not something that is easy. So barriers to entry into the airline industry is hard. I hope you get my points. Let's move on. Then the last but not the least is economies of scale. There are some companies, the more they produce, the cheaper the cost of production becomes. That's what we call economies of scale. The more they produce, the cheaper their products becomes. So they have that economies of scale. That's why you see that small companies cannot compete with them, because they have economies of scale. That's what you see Dangote doing, backwards integration, going to the source, expanding back, making sure that it is the source, is getting the source of its products. It has economies of scale. I hope you understand what I'm saying. So that is number 5 as regards competitive advantage. Then leadership. When it comes to the leadership, do they own the stocks of this company? Do they own it? You can see that on their financial statements. Number 2, what percentage is owned by insiders? You may say, what does this have to do? If they have part of it, let's say they have 30%, 20%, 30 or 40%, it shows that they will be after the share price. They will not want it to go down. That's the implication. But if they do not own part of the shares, maybe they are more or less concerned about their own salary. Their performance is not even tied to stocks, to the performance of the stocks. They are less concerned. But if they own the company stocks, then it is good. If a sizable amount of percentage is owned by insiders, then it's also good, because they will always be working towards the increase in share price. Then the last but not the least is the company led by the founder, or maybe an employed CEO. For instance, the CEO of Fitson just resigned. Dangote Refinery just got another CEO now. The CEO of Fitson just retired after 30 years of leading that company. That's a good company to buy, because definitely he was able to guide the company through the thick and thin of their sojourn for the past 30 years. I hope you understand. So once you see that it is led by the founder, it shows that definitely there's passion for the person to make sure that the company grows, because it is his brainchild. With this, I think I've been able to explain to us today what qualitative analysis is when we talk about stock analysis. In another video, I'll be talking about quantitative analysis. What are the basic quantitative analysis we need to look at? It is not every number that is as important as others. For instance, when we talk about current ratio, it's not as important as PE ratio. PE ratio is not as important as PEG ratio. I hope you understand my points. Thank you so much. If you are yet to subscribe to this channel, kindly do by clicking on the subscribe button. Click on the notification bell so you can be notified whenever we release a new video. So we meet in our next video. Stay blessed.